Question 1. Which of the following describes an indexed annuities interest calculation based on a stock market index? A. The annuity provides guaranteed returns directly tied to stock market growth with no limits on gains. B. The annuities interest is calculated using a cap rate and participation rate, which limits the amount of market gains credited to the account. C. The annuities growth is strictly based on dividends from the stocks in the chosen index. D. Interest is earned only if the annuitant invests in the specific stocks within the index. Answer B. The annuities interest is calculated using a cap rate and participation rate, which limits the amount of market gains credited to the account. Explanation. Indexed annuities offer growth potential linked to a stock market index like the S&P 500 without investing directly in the index. The growth calculation often includes a cap rate, the maximum interest credited, and a participation rate, the percentage of index growth credited. This mechanism limits the annuitant's gain while protecting against losses if the market declines. Option A is incorrect because indexed annuities are not guaranteed returns directly tied to market growth. They are limited by caps and participation rates. Option C is irrelevant as indexed annuities do not gain dividends. Option D is incorrect as the investor does not directly invest in the stocks. Question 2. Which of the following is true regarding surrender charges in an annuity contract? A. Surrender charges are applied only if the annuitant cancels the annuity within the first year. B. Surrender charges decrease over time, typically during the surrender period, and may apply to partial withdrawals. C. Surrender charges apply indefinitely throughout the life of the annuity contract. D. Surrender charges increase over time to prevent early withdrawals. Answer B. Surrender charges decrease over time, typically during the surrender period, and may apply to partial withdrawals. Explanation. Most annuities have a surrender period, often between 5 to 10 years, during which surrender charges decrease annually. If the annuitant makes a withdrawal or cancels the contract during this period, they may face a penalty. This discourages early withdrawals and protects the insurer. Option A is incorrect as surrender charges extend beyond the first year. Option C is incorrect because these charges are limited to a defined period. Option D is also incorrect as surrender charges typically decline over time rather than increase. Question 3, scenario-based. Maria, age 45, is interested in purchasing a variable annuity for retirement purposes. She wants her investment to grow through equity exposure but also wants to secure a minimum lifetime income regardless of market performance. What option would best suit Maria's needs? A. An indexed annuity with a high participation rate and cap. B. A variable annuity with a guaranteed minimum withdrawal benefit ride. C. A single premium immediate annuity SPIA to begin income payments immediately. D. A fixed annuity with a multi-year guaranteed interest rate. Answer B. A variable annuity with a guaranteed minimum withdrawal benefit ride. Explanation. A variable annuity with a GMWB rider would suit Maria as it provides equity exposure, allowing her investments to grow with the market and a guaranteed minimum income regardless of market fluctuations. This rider ensures she has lifetime income even if the annuity's market-linked investments underperform. Option A is incorrect as indexed annuities link growth to indices, not equity investments directly, and lack the guarantee Maria wants. Option C does not meet her need for future income security. Option D is also incorrect because a fixed annuity lacks equity exposure. Question 4. What is a key difference between qualified and non-qualified annuities? A. Qualified annuities are funded with after-tax dollars, while non-qualified annuities are funded with pre-tax dollars. B. Qualified annuities have mandatory distribution requirements starting at age 72, whereas non-qualified annuities do not. C. Only non-qualified annuities grow tax-deferred during the accumulation phase. D. Only qualified annuities incur penalties if withdrawals occur before age 59. 1, 2. Answer B. Qualified annuities have mandatory distribution requirements starting at age 72, whereas non-qualified annuities do not. Explanation. Qualified annuities, funded with pre-tax dollars in a retirement account, are subject to required minimum distribution RMDS starting at age 72 under federal law. Non-qualified annuities, funded with after-tax dollars, are not subject to these RMD rules. Option A is incorrect. Qualified annuities are funded with pre-tax dollars, while non-qualified are funded with after-tax dollars. Option C is incorrect because both types grow tax-deferred. Option D is incorrect as both types incur early withdrawal penalties before 59. 1, 2. Question 5. Which of the following riders provides additional income in cases where the annuitant requires long-term care? A. Death benefit rider. B. Guarantee minimum income benefit GMIB rider. C. Enhanced benefit rider for long-term care. D. Disability income rider. Answer: C. Enhanced benefit rider for long-term care. Explanation: the enhanced benefit rider for long-term care allows annuity holders to access additional income if they need long-term care. This rider is designed to help cover costs associated with nursing homes, assisted living, or in-home care. Option A provides a payout upon the annuitant's death but does not cover long-term care. Option B guarantees a minimum income, typically unrelated to long-term care needs. Option D focuses on income replacement during disability but does not specifically address long-term care. Question 6. For an annuity with a surrender charge schedule that starts at 10% and reduces by 1% each year, how much would an annuitant pay if they withdrew funds in the third year? A. 10%, B. 8%, C. 7%, D. 5%. Answer: C. 7%. Explanation: with a surrender charge schedule starting at 10% and decreasing by 1% annually, the third year would apply a charge of 10%. 3 per equals and percent. This type of schedule is common to encourage long-term investment. This calculation is simple but essential to understand for annuity holders considering early withdrawals. Options A, B, and D are incorrect as they do not match the progressive reduction over 3 years. Question 7. Which of the following best explains the exclusion ratio for non-qualified annuities? A. The ratio determines the tax-exempt portion of each annuity payment based on the original after-tax contribution. B. The ratio calculates how much of each payment is taxable income based on the interest earned during the accumulation period. C. The ratio applies only to qualified annuities and affects the withdrawal penalties. D. The exclusion ratio determines the percentage of annuity contributions that can be withdrawn without surrender charges. Answer: A. The ratio determines the tax-exempt portion of each annuity payment based on the original after-tax contribution. Explanation: the exclusion ratio applies to non-qualified annuities to determine the tax-free portion of each payment, reflecting the return of the original after-tax contribution. Only the interest portion of each payment is subject to income tax. Option B is incorrect as it reverses the ratio's purpose, which is based on the contribution rather than interest. Option C is incorrect since the exclusion ratio applies to non-qualified, not qualified annuities. Option D is unrelated as the exclusion ratio does not involve surrender charges. Question 8. Which of the following describes a potential risk associated with a variable annuity? A. Guaranteed interest rates are capped, limiting the annuitant's earnings. B. Payout amounts depend on the performance of selected investment sub-accounts, which may lead to losses. C. Premiums are tax deductible if the annuity is non-qualified. D. The insurer provides a minimum interest rate guarantee during market downturns. Answer: B. Payout amounts depend on the performance of selected investment sub-accounts, which may lead to losses. Explanation: variable annuities differ from fixed annuities because they involve investment in sub-accounts such as mutual funds that fluctuate based on market conditions. This means that both the growth of the annuity during the accumulation phase and the payout during the distribution phase are directly impacted by the market, unlike fixed annuities, which offer a guaranteed interest rate. Variable annuities have no such protection, leading to potential losses. Options A and D pertain to fixed or indexed annuities where interest caps or guarantees may apply. Option C is incorrect as non-qualified annuities are funded with after-tax dollars and do not offer tax deductions on premiums. Question 9. Sarah, a 60-year-old retiree, is considering different annuity payout options to ensure a steady income stream. She wishes to receive payments for her lifetime and wants her spouse to continue receiving payments after her death. Which option would best meet her needs? A. Life-only annuity. B. Life with period certain. C. Joint and survivor annuity. D. Lump sum payment. Answer: C. Joint and survivor annuity. Explanation: a joint and survivor annuity is designed for individuals who want lifetime payments for both themselves and a surviving spouse or beneficiary after their death. This annuity type provides income to the primary annuitant and upon their passing continues to pay the designated survivor, typically at a reduced rate depending on the annuity contract. A life-only annuity, option A, only covers the primary annuitant and stops upon their death, leaving the spouse without benefits. Option B, life with period certain, guarantees payments for a set period G. 10 years irrespective of the primary annuitant's life, but may not provide lifelong support for the spouse. The lump sum option, option D, offers a one-time payout which wouldn't provide the ongoing income Sarah needs. Question 10, scenario-based. David is 55 years old and considering purchasing a deferred annuity. He wants to take advantage of tax-deferred growth until retirement and ensure he has access to his funds if needed, but without incurring significant penalties. He's concerned about early withdrawal charges, especially if he needs funds before reaching 59.12. Given David's goals, what would be the most appropriate advice? A. Purchase a qualified deferred annuity as it offers tax deductions on premiums and no penalties on early withdrawals. B. Select a non-qualified deferred annuity and add a rider allowing partial withdrawals without surrender charges. C. Invest in a single premium immediate annuity to avoid deferred tax implications. D. Choose a fixed annuity with a high guaranteed rate for quick access to funds. Answer: B. Select a non-qualified deferred annuity and add a rider allowing partial withdrawals without surrender charges. Explanation: David's goals align with the benefits of a non-qualified deferred annuity, which allows tax-deferred growth on earnings, though contributions are made with after-tax dollars. By adding a partial withdrawal rider, David gains flexibility to access funds without surrender charges. This is important since withdrawals before age 59.12 typically incur a 10% IRS penalty. Option A is incorrect because qualified annuities are funded with pre-tax dollars but do not allow penalty-free withdrawals before 59.12. Option C is irrelevant as an immediate annuity begins distributions right away, not allowing for deferred growth. Option D does not align with David's requirement for liquidity and access, as fixed annuities usually involve surrender periods restricting immediate access. Question 11. In an indexed annuity, what is the function of a participation rate? A. It sets the minimum guaranteed interest rate for the annuity. B. It determines the percentage of index growth credited to the annuity. C. It limits the maximum rate of return based on market performance. D. It applies only to variable annuities, not indexed annuities. Answer: B. It determines the percentage of index growth credited to the annuity. Explanation: in an indexed annuity, the participation rate specifies how much of the index's gain is credited to the annuity's value. For example, with an 80% participation rate, if the index grows by 10%, the annuity would be credited with 8% growth. Option A confuses the participation rate with guaranteed interest rates. Option C describes a cap, not a participation rate. Option D is incorrect as participation rates are specific to indexed annuities, not variable annuities. Question 12. When considering tax implications, which of the following is true about non-qualified annuities during the accumulation phase? A. Earnings grow on a tax-deferred basis. B. Contributions are tax-deductible in the year they are made. C. Withdrawals are taxed as capital gains. D. The entire annuity balance is subject to annual income tax. Answer: A. Earnings grow on a tax-deferred basis. Explanation: for non-qualified annuities, earnings accumulate tax-deferred, meaning taxes are only paid upon withdrawal. This allows for potentially greater growth over time. Option B is incorrect as contributions to non-qualified annuities are not tax-deductible. Option C is incorrect because earnings are taxed as ordinary income, not capital gains. Option D is incorrect as taxes are deferred until funds are withdrawn. Question 13, scenario-based. Linda, 65, has a deferred annuity and wants to avoid a large tax bill. She is considering different payout options. Which option would most likely provide her with the most tax-efficient distribution? A. Lump sum payment option. B. A life-only annuity. C. Joint and survivor annuity with a 10-year period certain. D. Partial withdrawals over a 5-year period. Answer: B. Life-only annuity. Explanation: a life-only annuity spreads out distributions, potentially lowering Linda's taxable income annually and minimizing her tax burden. The lump sum option A would result in all gains being taxed at once. Option C, while a steady income involves certain complexities with taxes, if the 10-year period certain is completed. Option D may still result in a large tax liability within a shorter time frame. Question 14. What is the primary risk associated with variable annuities? A. Fixed interest rates could result in lower than expected returns. B. Market performance directly impacts the annuity's account value. C. Annuity income is only guaranteed for 5 years. D. There are no tax benefits with variable annuities. Answer: B. Market performance directly impacts the annuity's account value. Explanation: variable annuities are exposed to market fluctuations, meaning poor market performance can reduce the account's value. Option A is incorrect as variable annuities do not have fixed interest rates. Option C is irrelevant. Variable annuities offer a range of income options, not limited to 5 years. Option D is incorrect as variable annuities still benefit from tax deferral on earnings. Question 15. Which of the following accurately describes the free look period in annuity contracts? A. It allows the insurer to cancel the contract within 30 days. B. It permits the annuitant to withdraw up to 50% of the account value penalty-free. C. It enables the policyholder to cancel the annuity for a full refund within a specified time frame. D. It guarantees a minimum return rate during the free look period. Answer: C. It enables the policyholder to cancel the annuity for a full refund within a specified time frame. Explanation: the free look period allows annuity buyers to review the contract terms and cancel the annuity for a full refund if they change their mind. This period typically lasts 1030 days depending on state regulations. Option A is incorrect as the free look period benefits the policyholder, not the insurer. Option B is incorrect as it does not allow penalty-free partial withdrawals. Option D is incorrect because the free look period does not guarantee returns. Question 16. Which type of annuity is typically considered least risky in terms of preserving the principal? A. Variable annuity. B. Fixed annuity. C. Indexed annuity. D. Joint and survivor annuity. Answer: B. Fixed annuity. Explanation: fixed annuities offer guaranteed interest rates which help protect the principal from market fluctuations. Option A is riskier as variable annuities depend on market performance. Indexed annuities C may also involve some market-linked risks. Option D refers to a payout structure rather than the risk level of the principal. Question 17. An annuity contract includes a guaranteed minimum withdrawal benefit right. Which of the following is a key feature of this rider? A. It provides for tax-free growth on all gains. B. It ensures a set number of withdrawals regardless of the account balance. C. It guarantees a specific income amount even if the account balance drops to zero. D. It guarantees that all withdrawals are free of surrender charges. Answer: C. It guarantees a specific income amount even if the account balance drops to zero. Explanation: the GMWB rider ensures that a minimum income amount is available to the annuitant even if the annuity's account balance is depleted due to withdrawals or poor market performance. Option A is incorrect as gains are subject to tax upon withdrawal. Option B does not accurately describe a GMWB as the guarantee is tied to income, not a set number of withdrawals. Option D is incorrect as surrender charges may still apply in certain cases. Question 18. How does an exclusion ratio apply in a non-qualified annuity? A. It determines the tax-deductible portion of each annuity payment. B. It calculates the taxable and non-taxable portions of each annuity payment. C. It applies to the entire principal as a deduction. D. It only affects lump sum withdrawals from an annuity. Answer: B. It calculates the taxable and non-taxable portions of each annuity payment. Explanation: the exclusion ratio in a non-qualified annuity divides payments into taxable earnings and non-taxable principal portions. This applies until the full principal is recovered. Options A, C, and D misrepresent the exclusion ratio's function as it pertains to payment portions, not deductions or lump sum withdrawals. Question 19. Under Oklahoma annuity regulations, which requirement applies to an agent's duty regarding disclosure? A. Agents must disclose only if requested by the client. B. Agents are required to disclose all potential fees, charges, and features of the annuity. C. Agents may selectively disclose features beneficial to the client's understanding. D. There is no requirement for agent disclosure in annuity sales. Answer: B. Agents are required to disclose all potential fees, charges, and features of the annuity. Explanation: Oklahoma regulations mandate that agents fully disclose annuity features, including fees and charges, to ensure clients understand the product. This aligns with best interest standards. Options A, C, and D are incorrect because they do not meet the comprehensive disclosure requirement. Question 20. Which type of annuity is most likely to appeal to an individual focused on estate planning who wants to pass assets to heirs? A. Life-only annuity. B. Joint and survivor annuity. C. Annuity with a death benefit rider. D. Variable annuity without a rider. Answer C. Annuity with a death benefit rider. Explanation. An annuity with a death benefit rider provides for the transfer of remaining assets to heirs, making it suitable for estate planning. Options A and B focus on income during the annuitant's life. Option D lacks the rider necessary to ensure asset transfer to beneficiaries. Question 21. Which of the following annuity payout options provides the highest possible periodic payment amount but ends payments entirely at the death of the annuitant? A. Life-only option. B. Life with period certain. C. Joint and survivor option. D. Installment refund option. Answer A. Life-only option. Explanation. The life-only option provides the highest payout because it only pays for the lifetime of the annuitant with no additional benefits to beneficiaries upon the annuitant's death. Options B, C, and D provide continued benefits after the annuitant's death, resulting in low periodic payments. Question 22. In an annuity with a guaranteed minimum income benefit, GMIB, which of the following is guaranteed? A. A minimum amount of income regardless of the account value's performance. B. Full refund of all premiums paid at any time. C. The account balances protection from any market losses. D. Immediate access to the full annuity value without surrender charges. Answer A. A minimum amount of income regardless of the account value's performance. Explanation. A GMIB guarantees a minimum level of income even if the account's performance is poor, protecting the annuitant's income stream. Option B describes a return of premium feature. Option C describes a principal protection feature. And option D describes liquidity without charges, none of which are specific to a GMIB. Question 23. Which factor primarily determines the interest rate credited to a fixed indexed annuity? A. A stock market performance without any limits. B. A selected index's performance, limited by participation and cap rates. C. Changes in the bond market. D. The insurance company's discretion alone. Answer B. A selected index's performance, limited by participation and cap rates. Explanation. Fixed indexed annuities credit interest based on the performance of a specified index but are limited by participation rates, the percentage of the index gain credited, and cap rates, the maximum creditable gain. Options A, C, and D do not accurately describe how fixed indexed annuity rates are calculated. Question 24. Scenario-based. Mark purchased an annuity and opted for a 10-year period certain payout. After receiving payments for 4 years, Mark passes away. Which statement best describes what happens next? A. Payments stop immediately with no further distribution. B. Mark's beneficiary will continue to receive payments for the remaining 6 years. C. Payments continue only if Mark's spouse is the beneficiary. D. The annuity is cancelled and all funds are returned to the insurance company. Answer B. Mark's beneficiary will continue to receive payments for the remaining 6 years. Explanation. With a 10-year period certain, the annuity will continue to pay Mark's beneficiary for the remaining period, which is 6 years. Option A is incorrect because the period certain ensures payments for the entire 10 years. Options C and D do not accurately represent the terms of a period certain payout. Question 25. In Oklahoma, when is an insurance producer required to complete annuity suitability training? A. Only when the producer first starts selling annuities. B. Every year to keep their license active. C. Prior to recommending or selling any annuity products to consumers. D. Within 30 days of the first annuity sale. Answer C. Prior to recommending or selling any annuity product to consumers. Explanation. Oklahoma requires producers to complete annuity suitability training before recommending or selling annuity products to ensure they understand the requirements and can act in the best interest of consumers. Options A, B, and D do not meet the regulatory requirement for training before any annuity transactions. Question 26. Which of the following best describes the tax treatment of an inherited annuity by a non-spouse beneficiary? A. The beneficiary can receive the remaining funds entirely tax-free. B. All distributions will be taxed as ordinary income. C. The beneficiary may claim a capital gains tax benefit. D. Only the earnings portion is taxed while the principal is tax-free. Answer B. All distributions will be taxed as ordinary income. Explanation. For non-spouse beneficiaries, annuity distributions are taxed as ordinary income regardless of the principal and earnings portions. Options A, C, and D are incorrect as there are no capital gains or tax-free benefits on inherited annuity distributions. Question 27. Which provision allows an annuitant to withdraw a certain percentage of their annuity's account value annually without incurring surrender charges? A. Free withdrawal provision. B. Deferred growth provision. C. Cap rate provision. D. Guaranteed lifetime benefit provision. Answer: A. Free withdrawal provision. Explanation: a free withdrawal provision allows the annuitant to access a limited percentage of their account value, often around 10% annually without penalty. Options B, C, and D describe unrelated provisions that do not allow penalty-free withdrawals. Question 20. What happens if an annuitant chooses to annuitize their contract with a life-only payout option? A. The annuitant receives payments only until they reach age 85. B. Payments continue for a fixed term regardless of the annuitant's death. C. The annuitant receives payments for their lifetime with no payments after death. D. Beneficiaries will receive a lump sum upon the annuitant's death. Answer: C. The annuitant receives payments for their lifetime with no payments after death. Explanation: with a life-only payout, payments are made solely for the annuitant's life, ceasing upon their death with no continuation for beneficiaries. Options A, B, and D misrepresent life-only payout terms. Question 29. Which of the following accurately describes the 1035 exchange in annuities? A. It allows a tax-free exchange of an annuity for cash. B. It permits a tax-free exchange between two annuities or certain life insurance products. C. It enables an annuitant to avoid surrender charges when switching annuities. D. It allows the annuitant to convert an annuity to immediate payments without penalties. Answer: B. It permits a tax-free exchange between two annuities or certain life insurance products. Explanation: a 1035 exchange allows for a tax-free transfer of funds from one annuity contract to another or from life insurance to an annuity, provided IRS guidelines are met. Option A is incorrect, as it does not involve cashing out the annuity. Option C does not address tax-free exchanges. Option D describes annuitization, not a 1035 exchange. Question 30. If a fixed annuity's interest rate is guaranteed for 5 years, what happens at the end of this period? A. The contract automatically annuitizes. B. The interest rate resets based on current rates. C. The annuitant must withdraw the funds or face penalties. D. The interest rate is locked at the initial rate indefinitely. Answer: B. The interest rate resets based on current rates. Explanation: in a fixed annuity, at the end of a guaranteed period, the interest rate typically adjusts to the insurer's current rate for similar contracts. Option A is incorrect, as contracts do not automatically annuitize. Option C is incorrect, as funds can remain in the annuity without penalties. Option D is incorrect, as interest rates do not remain locked indefinitely.